Good morning, everyone, and welcome to the CEFC's Green Room webinar today. We're excited to have you here, and we have a fantastic panel to talk about my favourite topic, which is exploring Australia's low-carbon liquid fuel potential. My name is Mila Nundang, and I'm an associate within the alternative fuels team here at the CEFC, which has led me to do some very purpose-driven work, including but not limited to facilitating this webinar today. So before we start, I'd like to acknowledge the Turrbal and Yagara people, the traditional custodians of the land I live and work on here in Brisbane. And I'd like to pay my respects to elders past and present and recognise their connection to the land we walk and the communities that we're part of today. So a small spot of housekeeping before we get going. Today's session, it'll run for about an hour, and then at the end of the webinar, we welcome the audience members to ask questions. So on your screen, you'll find a small Q&A box for that, and we'll try our best to answer those. At the end of the webinar today, there will also be a short questionnaire. So if you do get the opportunity, we would appreciate your feedback. Now, before I introduce our prestigious panel, I'd like to quickly talk to our report that was released not too long ago, commissioned by the CEFC and prepared by Deloitte. The report provides a deep dive into low carbon liquid fuels, why we need them, what they might look like in the Australian context, and how we can navigate the barriers to scale and the barriers to investment. So on your screen, you'll also see a resources box, which has a link to the report and its supporting information. So the webinar today will touch on our report and some of its key findings. So as we speak, we encourage you to use these resources to follow along. And with that, I have the pleasure of introducing on my expert panel today, Fiona Messent, who is the Chief Sustainability Officer at Qantas. Her background is an economist and decades of experience in the sustainability sector, advising governments, corporates and the likes is sure to bring a really great perspective from Qantas. So it's great to have you today, Fiona. We also have Rupert Maloney, who leads our alternative fuels platform at the CEFC. And after 5 years, he continues to chase those ambitious molecules. Rupert's played a really important role in developing opportunities in green hydrogen here at the CEFC. So if you thought he'd be ready to take the back seat, you'd be sorely mistaken, as he takes the wheel again for the challenge that is low carbon liquid fuels. We also have joining us another glutton for punishment, James Boyle, who is a director in Deloitte's climate and sustainability practice. James has had the front row seat to some really impactful climate and economic policy projects and has had the chance to shape some really major initiatives across all the exciting sectors like hydrogen, green metals, and of course, low carbon liquid fuels. So he's been super instrumental in the thinking room for our report. And if the whispers are true, he is also the creative genius to our report name, Refined Ambitions. So without further ado, James, I'll start with an easy one for you. Can you tell us what are low carbon liquid fuels and who might we see using them?
Thanks, Mila, and really excited for the discussion we've got ahead of us. So low carbon liquid fuels refer to a range of alternative fuel types, so it can be biodiesel and ethanol, so the first generation. We use it a lot in the report to refer to renewable diesel and SAF, but it also can extend to methanol, and ammonia as well. Renewable diesel and sustainable aviation fuel, or SAF, are drop-in biofuels, right? So they're drop-in low carbon liquid fuels because they can work in existing engines and drivetrains without upgrades, right? So this means they can be dropped into a range of assets that are already operating and reduce the emissions of those assets. They're able to do this because the fuels are recycling carbon that's already in the atmosphere, unlike fossil fuels, which are releasing carbon that's been stored up for millennia and millennia. So these fuels are produced through a range of different pathways, through lots of different feedstocks, some wastes, some fats and oils, and also there's options to produce through hydrogen and through captured carbon. The reason these are particularly important is because they're a massive driver of Australia's emissions footprint. So we consume about 56 billion litres of liquid fuels in any given year in Australia. that works out at about 150 megatons of carbon equivalent. That's about a third of our national emissions. It's a lot. Electrification is going to play a really important role in reducing some of those emissions, but there's a range of sectors which can't electrify. So in our view, low carbon liquid fuels present a really important way to decarbonize our economy, decarbonize the sectors that are hard to electrify.
Yeah, great. Thank you, James. And you mentioned liquid fuels makes up almost a third of national emissions. So if we double click on that, we see a lot of sectors, but more specifically, we see that aviation takes a pretty hefty slice of the emissions pie. So Fiona, maybe you can take us down the runway, if you will. Why are low carbon liquid fuels, and more specifically SAF, so critical for Qantas? And if these fuels don't scale locally, what are the decarbonisation realities for an industry like aviation?
Thank you, and great to be here. Well, as probably is no surprise to anyone, aviation is a hard to abate sector. And so the reason that we are doing so much in the low carbon liquid fuel space is because SAF is really the only lever we have to decarbonise at scale, particularly as a long haul carrier, but also aviation in general. There is a lot of work being done on hydrogen or electric propulsion planes, but they are a couple of decades off from a commercial perspective, and they will probably be on those much smaller regional type routes. And so as a national carrier and an ultra long haul airline, SAF is the main game for us when it comes to decarbonisation. I think the fact that it is a drop-in fuel is really important to us. We are flying aircraft that could potentially still be in service in 2050. So we need solutions that can decarbonise fleet that will still be in operation in a couple of decades' time. We think hydrogen obviously has promise, but as everyone on this call would know, there's still a lot of challenges to getting hydrogen to scale. Obviously, there's also important infrastructure investment that would be required at the airports in order to enable that to be a reality. And so we really think that we can't wait for those breakthroughs to happen, and we need to do everything we can across the supply chain to scale low carbon liquid fuels as soon as possible.
Yeah, thanks, Fiona. Like you said, we're really characterised by moving our people and our goods, those really long distances. So without that scalable solution, the road looks pretty bumpy. So now if we were to zoom out a bit and look at the global market, we're seeing that low carbon liquid fuels are at a bit of an inflection point. And that's thanks to some supportive climate and economic policies we can see in those overseas markets. So maybe if I throw to you now, Rupert, it raises an important question for us here at home. Where does Australia fit in that puzzle, and what might we be missing out on if we don't keep pace?
Yeah, thanks for that, Mila. We are indeed at an inflection point. The race is on at the moment. So maybe if we step back a little bit. So the traditional markets in biofuels or low carbon liquid fuels has really been markets like Brazil, the ethanol markets there, and North America. So those markets have had policy support for many, many years now, and the fuels are really embedded in those systems. But over the last few years, there's been a real acknowledgement globally across many different countries of the need and the requirement for low carbon liquid fuels. So Europe is a big call out there. They've started what's called Refuel EU, which is a mandate system. So now, as of the 1st of January this year, when you fly into European airports, there's a requirement that a certain proportion of that fuel needs to be SAF, and that requirement or that mandate will build over time. So that's driving the market from a demand side. But it's not just these European or these developed markets like Europe or the US. It's incredible what's actually happening in our region. So across our region, there's been a number of mandates or targets announced over the recent period of time. These are countries like Japan, Korea, Malaysia, Singapore, India, even Indonesia has a mandate announced. And what's driving that is really driven by obviously decarbonisation aspirations, as Fiona touched on in the aviation market and some other markets. This is the key decarbonisation technology. But the other key driver here is fuel security. So as we transition to a lower carbon economy, fuel security and where the liquid fuel comes from and having control of supply chains, so producing that fuel, that low carbon fuel in country becomes more and more important. So that's been a key driver of some of those markets, is really controlling feedstock within country and producing product or low carbon liquid fuels within those countries. So that's driving a real demand for global feedstocks, including feedstocks here in Australia. So a lot of our feedstocks are exported to be processed in these markets. So it is an inflection point. It is a race. There is a challenge that if our feedstock is all contracted to these offshore markets, that it could be too late if we wait too long to stimulate the market here for production. So it becomes very important from supply chains, from fuel security perspective, and ultimately from a decarbonisation perspective.
Yeah, thanks, Rupert. It does really highlight what's at stake. And maybe if we change tacks a little bit and focus on us here at the CEFC, we know that we've been long committed to helping build out these new energy sources and supporting these more emergent markets. So this conversation does really sit in our wheelhouse. From your perspective, maybe you can talk to why it was important that we did commission this report.
Yeah, happy to. So if we take a step back, so the CEFC, what is our role in the market? Our role really is about facilitating finance into the clean energy sector and facilitating the achievement of Australia's greenhouse gas emissions targets. So we look at that very seriously. We do that through a number of different ways, but obviously through investment, where at the end of the day, we're an investment fund, but we also do that through educating the market. So we look at reports like this as a really important element to not only learn internally, so we can be tooled up when we look to make investments in this sector and we understand the sector very well, but also disseminate that information and that knowledge to the market, because ultimately our goal is to make sure that the investment markets are ready to invest in these projects when the projects are looking for investment. So we can do that through sharing our knowledge, through conversations like today in this report, and then also working with other investors, working with market participants, working with fuel buyers to disseminate that knowledge as well. Because ultimately our goal at the end of the day is a market that's investable. So not only the CEFC can underpin some of that investment, but ideally the private sectors are investors as well. And so bringing everyone up the curve through a piece like this, we hope is beneficial to the market when these projects are looking for investment.
Yeah, absolutely. Great. So now that we've set the stage, I think we can dive into the fun stuff. And if I throw back to you, James, maybe you can give us a bit of a peek behind the curtain, and also without sending us into an economic modelling spiral, can you give us some colour on the supply and demand modelling and how that was crafted, and also what that market clearing process looks like that facilitates some of the scenario analysis that we see in the report?
Yeah, so what a tough question. Do it without diving into the deep end of econ. So it's a really tricky one, right? Because you've got a range of different buyers, right? So we've modelled 6 different sectors who are purchasing low carbon fuels, and they're purchasing different molecules, right? So aviation, is purchasing sustainable aviation fuel. Sectors like mining, construction, others are purchasing renewable diesel. We went and spoke to those sectors, right? So instead of doing sort of a top-down picture of, what demand could look like in different versions of the universe, we went and spoke to people. We said, what are you buying for? How are you thinking about that? And we constructed a set of scenarios. And there are 2 things that really stand out there. One is that fuel users are buying on abatement cost terms, right? So we can't think about this just in terms of $1 per litre equivalents. We've got to think about the way that fuel users are purchasing, decarbonisation, and we've they have a range of options available to them. So they are looking for the least cost abatement pathway here and the fuels which will provide them that. And so, in some cases that's electrification. In some cases, particularly in our low scenario, we've given our fuel users the options of purchasing carbon credits, and a lot of them do, right? So the other piece that jumped out to us very strongly on the demand side is that in the absence of some, elevated carbon price or other market intervention, very limited volumes of low carbon liquid fuels will actually be purchased in Australia. We need to see intervention to get that up. So then we go to the supply side, where we have a production cost model which looks at 4 different production pathways. So we look at the 4 dominant ones that seem to be out there: HEFA, a gasification pathway, FT, an alcohol or ethanol to jet pathway, and power to liquids, which uses hydrogen and captured carbon, and a range of different feedstocks. So some wastes, some carbohydrates, a few other things there. And we spoke to a range of the suppliers out there in the market, so people who are actively developing projects in Australia. We tried to understand the value chain right from feedstock through to finished fuel, and we then try and compete those projects against each other. So we develop a set of synthetic projects, we play them off against each other in the market, and we look at available feedstock volumes, the price point of those feedstocks. We build out a supply curve for the market, and it has a very distinctive shape, and that shape evolves over time. What it tells us really clearly is that on an abatement cost basis, the way that we anticipate fuel users will purchase fuels, there are some clear winners early on. Then there's a bit in the middle of the supply curve where if demand reaches a particular threshold, there'll be a lot of competition, potentially a lot of diversity in the market, and then it gets real steep really quickly. But I think it's really important to say that at this stage, low carbon liquid fuels are expensive. They are an expensive form of decarbonisation, and without the right market signals, we don't have the incentives in the market to drive some of those costs down on an abatement cost basis.
Yeah, great. And maybe, I think you'll like this question. I'd like to know, what was challenging about modelling the ways low carbon liquid fuel uptake does evolve over time?
Yeah, so it's a bit of a tricky one. So if you're modelling, just one user segment and just fuels, pretty straightforward, right? Because you're just competing one commodity against another in a market. This one, we had to model a range of different suppliers and a range of different participants. It's not quite as complicated as, say, the way the energy market works yet, but that's the direction it would evolve into. And we had to think very carefully about the other or the alternate abatement options available to the fuel users, right? So we have made some very explicit assumptions about electrification. We've made very explicit assumptions about the sequencing with which fuel users, right across the spectrum, will actually engage in decarbonisation. And we've, in consultation with you guys, tried to make that as transparent as possible. So there is a very detailed appendix that runs a similar length to the report that's available out there. I think we're quite keen for people in the market to engage with some of those assumptions and ideally to challenge them, right? Like, we've tried to put the definitive picture out there. It's pretty hard to be comprehensive given the complexity of this market. We think it's the right starting place.
Yeah, absolutely. Thanks, James. I'll let you warm the bench because I think it would be a great chance to contextualise all of this. And we know back in May that Qantas imported the largest commercial shipment of SAF into Australia to date. So if I throw back to you, Fiona, why was this important for Qantas, and what were some practical insights that emerged that could guide similar efforts going forward?
Yes, thank you. We did that back in May because, for a couple of reasons, we have been picking up SAF out of London Heathrow for the last couple of years. We've been picking up about 10 million litres a year, but we really wanted to test the infrastructure here in Australia. We obviously do not produce SAF here in Australia at the moment, so we had to look at importing in order to do that. And It was a really great example of the collaboration that is possible and necessary to be able to scale SAF. So we did this with the support of our SAF Coalition, which is our corporate partnership program, where we have 15 of the leading corporates in Australia, including Deloitte, who help us reduce that green premium that we've just been talking about. So we did that in partnership with not only the SAF Coalition, but also Sydney Airport. Partly to, as I said, test the infrastructure, but also to show that there is that demand there. So we need government to be a part of the solution, and part of doing this import was to raise awareness and advocacy of the need to develop the industry here in Australia, because like has been discussed, we know that the feedstock is here, we know that the potential is here, and the need because of the fuel security piece. But we need to make the economics stack up. And so you need that policy piece too. But we were really excited to get it done. 2 million litres is the largest into Australia, but it obviously is nowhere near enough or a material amount that would have a big impact on our emissions overall. So we do want to be doing more of this, and ideally we'd rather be picking it up in Australia, made in Australia, and flying in Australia. So looking forward to the rest of the conversation on the policy side of things as well.
Yeah, thanks, Fiona. It is great to see a tangible example of what, our progress can look like if a little bit of ambition meets some action. And I guess what I hear from you all so far is that to build this scaled ecosystem, it's going to need a bit of love across the entire value chain. So if I maybe jump back to you, Rupert, what do you see as the main barriers holding back capital in this space? And how does the CEFC view its role in helping clear some of those hurdles?
Yeah, thanks, Mila. So I think the report does a really good job. Towards the back of the report, it steps through some of the key risks or barriers which do need to be addressed to get a project to go forward. And so maybe if we just at a high level steps through some of them. So obviously price risk and volume risk or demand certainty. So what do we mean by that? At the end of the day, any SAF or low carbon liquid fuels production project is going to produce a refined product. As James said earlier, it's a drop-in product. So very similar in chemical characteristics to the underlying kerosene, jet fuel or renewable diesel. However, it will be produced at a price premium. So we're not talking about a sort of a 5-10% premium. We're talking about in the order of many multiples or a number of multiples of the price of the underlying fossil fuel price. So any project producing a product needs to be certain that there will be a buyer willing to pay the price that they need to achieve their return on capital. So that can be done through a few different ways. That can be done through a commercial contract if we can find a buyer willing to pay that premium. But any buyer in these competitive markets, like aviation or like mining or heavy transport, needs to be in a competitive position. So they need to have the ability to pass that price on to their customers or deal with it. So that's usually done through policy mechanisms, as I touched upon earlier. You have a demand side or a supply side policy mechanisms which can bridge some of that differential. Because, example, if there's a mandate in a market, which I touched upon earlier, if you're mandating that a certain proportion of that fuel needs to be SAF, for example, then the whole market needs that certain proportion to be SAF. So then the price comes up for that fuel producer because they're selling into a mandated market and there's a level of certainty. So there's different ways to address that demand certainty and the price certainty. The other side, which makes it difficult, is the variability in feedstock. So what we're talking about here is mainly or initially biogenic feedstocks to produce these fuels. And so those biogenic feedstocks could be tallow, for example, which is a waste product from abattoirs. It could be used cooking oil. It could be canola oil. And these are commoditized markets. There's variability in seasons. There's variability in price. So there's not really a correlation, or there's not a full correlation between those feedstock price and the end price for that fuel. So that's a challenge there, is that the project also needs to contract a certain quantity of that feedstock at a certain price over a long term. And a lot of these markets, both the fuel market and the feedstock market, traditionally are short-term markets. They're contracted over the short term, not over the life of a project. Then you've got technology risk is another key risk here. If this technology, there's different technologies that, as James said, that the report covers. Some are more mature than others. So when we're looking at financing or investing in a project, you need to understand, does the technology do what the technology says it can do? And in a difficult refining chemical processing environment, there's challenges, and there's certainly challenges for the newer technologies when it hasn't played out over an extended period of time, when the catalyst hasn't been used for many, many years. And so understanding how that works flows into the cash flows of that project. Because if the technology is not operating the way that it's meant to operate, if there's challenges, that has a direct impact on cash flow. And then the final key barrier is what I've touched upon, but that policy, what is the policy going forward? Is it certain? Will it stay? If a policy is announced by government, will that policy stay for over the period that it's announced for? And because the project developer will be building the project based off that policy. So understanding these barriers, but not just understanding them, addressing them through the structure. And that's where I think there's a role for all those participants in that project, whether that's the off-taker, the project developer, the feedstock provider, or the capital providers, to play a role, and also governments from a policy perspective. But from the CEFC perspective, we ultimately will be a capital provider into a project, likely in the form of debt, could be concessional debt is one of the tools that we have. And that means that we could go into these projects, the earlier projects, the first of kind projects, because traditionally debt providers are conservative. They need to, by their nature, where they fall in the capital stack, they need to be more conservative. They're looking at downside risks rather than equity, looking at upside opportunities. And so they need to, that technology risk, for example, they need to understand how that technology plays out. So there's a really important role for a government financier like the CEFC to not take all those risks with very wide eyes and do all the work on the risk and come up with mitigants, but not start from a position of no, where a lot of commercial funders may be initially for the first of kind projects, because it is difficult. So we've got a history doing that. We've done that through a number of clean energy sectors. We were the first financiers into the renewable energy generation sector when we were first formed. That was a key focus of our business. But now we're moving out to other sectors where really important clean energy technologies that require a flexible funder or financier like the CEFC to be willing to structure around for mitigants to enable financing into these first of kind projects.
Yeah, thanks, Rupert. And with the complexity of this market, understanding the investment landscape will become really critical as we look at how we can scale production. And of course, investment doesn't happen in a vacuum. It's already been mentioned a couple of times before. We know that policy will influence the speed and the scale and complexity of our domestic industry. So maybe I'll throw back to Fiona from a fuel user's perspective. What are some policy priorities that you think may need to be addressed that would help unlock a bit more progress in this space?
Yeah, well, maybe at a high level, I think, as I mentioned before, industry-wide action is essential. I think it's like any new technology or solution that's come into the market similar to solar and wind. You need to prove across the supply chain that demand is there and that supply is possible. And that's really what we're seeing with SAF as well. So no leading airline is going to be able to solve this alone. And that's really the way that we've approached this, is looking across the value chain. How can you de-risk at those different points? We think the government is the enabler to unlock the scale required. So while we've been playing at the small end, where we can access the supply and partner with other corporates to make this happen, I think what will get the scale required and at the pace required is that government policy piece. Initially, I think, a year ago, we were probably lamenting the fact that the Australian government hadn't moved on any policy. But I think given what we're seeing from the policy that has been implemented around the world, we're actually in a really beneficial position to learn from those other jurisdictions that have gone ahead of us. And there are this is a new industry that we're standing up. So there will be more and more lessons that we can learn. And I think Australia actually being slightly behind gives us an opportunity to leapfrog, because we can design a policy that's best fit for us, taking into account the lessons of Europe, for example. We think balanced policy is key. You need both the demand and supply side to come together in order to do this in the most economically efficient way, but also, so again, back to that kind of accelerated supply piece as well. And you need to make sure that sustainability is part of that as well. So carbon intensity is an important factor in how we're designing the policy as well. I think the lessons from the EU that we're at least seeing play out at the moment is that complexity in these mechanisms can actually hinder market development. So there's, I think it's hard at the moment for a lot of project developers to really even know what they're eligible for, and then at the other opposite end of what is actually being asked of fuel suppliers. And so I think keeping it simple is important. You need that supply side support to really get the scale of supply in the early days. A mandate alone will not do that. It will just create a lot of cost to the industry. And then ambition must be matched by those supply considerations. So whether you look at phasing it in slowly or how you managed with imports in the early days before the domestic industry gets scaled, I think those kind of considerations will be really important as we look to this in Australia.
Yeah, absolutely. And maybe we can turn to thinking a little bit about Scope 3 emissions reduction here with you, Fiona. Can you share your perspective on which customer segments you think might be most willing to pay this cost premium today or in the more near term?
Yeah, and we're testing that at the moment with the SAF coalition that I spoke about, and we're really seeing the demand come from the freight forwarders. I think globally, DHL is one of the largest consumers of SAF themselves, but we also see a lot of Scope 3 deals happening with the freight forwarders and their customers as well. I think the tech companies and professional services firms and banks that are doing a lot of travel and don't have the ability to reduce those Scope 3 emissions because it is through air travel are really important partners for us. And I think that will hopefully continue to grow. And then, of course, resources and mining. We're continuing to think of how we can broaden our partnership beyond our own supply chain to think about resources and mining. They have a lot of FIFO flying, but also they're trying to equally decarbonise their heavy transport. So is there an opportunity for us to think about renewable diesel and SAF that will be produced from the same plants to look at how we can collaborate to bring down the cost there as well?
Yeah, absolutely. All right, Rupert, I have another question for you. And when we unpack the key investment risks, maybe you can talk to what specific signals across the key contracts, such as feedstock, technology, and EPC, that investors might need to see to gain a bit more confidence in committing capital at scale.
Yeah, happy to. So I touched upon some of this earlier, but it is important that I don't think any of the early investors like the CEFC, I don't think we expect a no risk position, that everything is that all the risk is on the other participants. So I think there will need to be a shared risk situation. So by that I mean, so the off-takers, the buyers of the fuel, will probably need to contract in a different way to the way that they're contracting today. Fiona can talk to it, but traditionally an airline contracts, buys their fuel, relatively short term. When I'm saying short term, it's sort of rolling 1-2 year contracts. It's based off an index price. So the oil market is a very liquid market, and they have the ability to hedge on their side those costs, but it's short term. They're not going to one fuel provider and saying, I will contract at a certain price for the next 20 years. That's not how that market operates. Similarly with the feedstock providers, they contract relatively short term. You've got a canola producer all the way down at a farm level who will look to maximise their price where the market is in a shortish term nature. So how does that need to change? And then you've got a financier as well, or an investor who needs it all to be contracted, certainly at a debt side, on a take or pay, very, very certain contracting terms. So how will that need to change to get some of these first projects up? I think some of that risk needs to be shared. I think government policy needs to have a role there as well, because I think that's the challenge today. Why are there no projects happening today in Australia? The challenge is that you can share all those risks as much as you want right now, but it doesn't get you there because you're still producing a product that is at a material premium to the alternative, and the policies, things like safeguard mechanisms, a mandated market for carbon emissions is an economy-wide mandate, so it doesn't bridge the gap for specific hard-to-abate sectors. So there's a challenge there. There's a challenge across the project. There's a challenge with that cost gap, and how will that play out is the question. As Fiona said, which I totally agree with, is we can learn a lot of lessons. Not coming first in these markets, there are some advantages. We can sit back and design, understand, both from a policy perspective, but also from a project perspective, because there are some more mature technologies in this space. Heifer, which the report goes into from a cost of abatement perspective, is the lowest cost of abatement. It is the most mature technology. And we have a great competitive advantage with those feedstocks that go into the heifer technology. So if we're looking to manage those risks from a contracting perspective, from a financing perspective, then we actually have some real advantages to actually potentially start there, because it's the lowest cost of abatement. It's going to be the most competitive in the market. And we have the feedstocks today that a lot of those feedstocks are being exported and processed through heifer technologies overseas. But there's great, it's really exciting to see what's happening in innovation and R&D in the agriculture sector, to develop new crops, develop cover crops, oil-based cover crops, which ultimately will go back through a heifer technology to expand that feedstock pool. So there's a lot happening. There needs to be a collaborative situation across that project and with government, and we have a lot of competitive advantages as well.
Yep, great. Thank you, Rupert. You've all laid down some really great insights so far. I'm conscious there's lots of questions coming through that we'd love to cover off. So to wrap things up from me, I'm keen to hear from you all what's next. So maybe some rapid fire thoughts, and I'll ask all three of you, looking ahead, what is your ambition for the next phase of evolution of low carbon liquid fuels in Australia? And I might start with you, James.
Yeah, sure thing. So look, we've spoken about policy a lot. The government is, sending some interesting signals there on the sorts of things they're considering. I think it would be good to get on with the job. I think it's really important for both fuel suppliers, feedstock providers, and fuel users to understand that this also needs to be de-risked on the government side. You can't just engage in what is fundamentally a very complex policy area that has the potential for a lot of unintended consequences without providing government with a degree of assurance around the consistency of the asks, but also the consistency of the outcomes. So I think there are a set of actions that the private sector can actually take to de-risk the sorts of intervention they're asking government for. And the other thing that I'd point to is COP31. It's a really big platform, right? It's potentially going to be in Adelaide, and it's less than 18 months away, right? I think there's a really important opportunity to use that as a stepping stone and a platform to demonstrate our leadership and to capture market opportunity into Asia, right? We're already exporting feedstock. We could do more there.
Yeah, great. And I'll throw to you now, Rupert.
I think building on a lot of this momentum that we sort of just spoke about up front here, there's a lot of great things happening in Australia in this market. It is exciting. I touched upon a few of them earlier. But from a government perspective, it's exciting as well. The Commonwealth Government's out for consultation for what sort of policy package will be considered at a government level. And that's under the Future Made in Australia banner. So it's great to see low carbon liquid fuels elevated through that Future Made in Australia platform. And there's a bunch of other things that are happening. There's something called the Jet Zero Council, which is an important forum to have these discussions back directly with government. There's hopefully this knowledge piece is helpful for the market as well. There's a lot happening. So I think embracing some of that momentum and then really focusing on our competitive advantages here. I think that's vital. I think it's so vital that I think the worst thing, very exciting, the worst thing for the industry would be a failed project early on. So we don't want that, certainly from an investor's perspective. And we think that the best way to mitigate that risk is obviously all the things that I've discussed. I won't repeat that, but also focusing on the most competitive projects. So production, when I say competitive, I'm talking about competitive on a cost of abatement perspective, because ultimately whatever comes from a policy perspective, it will still allow the market to compete, I hope. And if we're backing those most competitive projects early, the projects that can stand up on their own 2 feet in the market based on the policy mechanisms in this market, but also globally, and they're producing product which is down in that bottom quartile, at least in that bottom quartile, ideally down even further from a cost of abatement perspective, then they're going to be the most competitive projects. As this global market grows, they will have the best chance to thrive, and then we build off that.
Great. And Fiona?
Yeah, well, I echo everything that's just been said, but I would say that we are in a critical window here, and we do not want to get into a situation where, I think Rupert referred to it, we're exporting all of our feedstock and it's been refined overseas and then we're importing it back in at scale. I think there's a critical opportunity here for the Australian government to enable, and I think we're really just looking forward to continuing to engage on how that policy development plays out. I agree that it does take a risk sharing across the whole industry, and that's certainly the approach we're taking. I think the really positive thing with how this is developed across the Jet Zero Council and other forums is there does seem to be general industry alignment about what needs to occur here. I think obviously as the rubber hits the road with the policy details over the next 12 to 18 months, that's where it will always become a bit harder to get that really deep alignment. But I think we just see it as such a critical lever that we have as Australia, given its vast distances for aviation, that we need to work out how to make this happen. And as James said, I think COP does provide a really great window for us to get this done as the rest of the world's eyes are on us.
Yeah, great. Thank you so much, Fiona. We've covered some really great ground so far. So I'll open up to some of the questions from the audience, and I will stick with you, Fiona. There's a question here. Can you outline whether Qantas will invest directly into clean fuel production capacity in Australia?
Yeah, so we actually have a $400 million climate fund that we have partnered with Airbus on, and we are investing across sustainable aviation fuels and carbon credits and nature-based solutions. So we have made a couple of investments from that fund. We've committed over $100 million into a few different projects, one here in Townsville called Jet Zero. There's a lot of Jet Zeros in aviation, but this project is Jet Zero Australia. It uses alcohol-to-jet technology to convert ethanol into SAF. We think there's a lot of potential it's hoping to come online in 2029, I believe the latest date is. Maybe it's 28. But that's slated to produce 100 million litres of fuel a year here in Australia. So we think that is a really great step, but obviously you need that policy to ensure that it continues to develop. And we've also invested in a project in New Zealand and a fund in the US that's really looking at brownfield conversions. So where the refinery already exists, or perhaps it's producing renewable diesel and it just needs a slight change to the way that the production is designed, then we think that that's quite hopeful in bringing online supply quicker than some of these, greenfield projects that are using some of the second and third generation technologies. But we do see we have an important role to play in that catalytic part of the startup phase, where we can attract investors at a larger scale. We know how to fly airplanes, so we don't want to be owning refineries or SAF plants, but we do think that we can provide that early stage demand signal that we need these plants to get up. And then, as we've seen with Jet Zero, some of the bigger investors can then come in, including the Queensland Government, ARENA and Idemitsu from Japan. And then, at the right time, we can then also be an off-taker as well once the fuel is actually being produced. So we'll continue to scour for opportunities, and we have a couple in the pipeline at the moment. But I think what will really catalyse that pipeline is when we see policy action.
Yeah, great. Thank you. So I have a question here for James I think you'll like to answer. So given the significant cost premium and variability in willingness to pay across end fuel types, what does effective demand and supply side policy look like in the Australian context? And how do we make sure an effective two-punch is implemented at the federal level?
Yeah, it's a good question. And what it's really getting at is that if we just implement a demand side policy, so let's say we do a mandate and we model the equivalent of Europe's Refuel EU in our third scenario in the report, there's a whole lot of demand, but we probably start by importing supply from elsewhere. So if we just go ahead on the demand side, we're creating a big signal in the market, that's great, but it's not necessarily meeting some of those economic development or fuel security objectives. So that's one consideration. The other consideration is if you only intervene on the supply side, you have to provide a whole lot of support. Basically, to make a project bankable, you almost have to fill the entirety of the cost gap. That's incredibly expensive, A, and B, there are a whole lot of nuances across the different production pathways, which mean, you would probably want to change whether it's a revenue support option, whether it's a margin linked incentive, whether it's a capital grant. Those things are just going to depend on the specific characteristics of the project. It's really complicated and it can't work at scale. So my personal view is that we need a market-based mechanism. So we need something that doesn't necessarily have to be what California has done with their low carbon fuel standard, but I think that's a very good demand side intervention that encourages technology neutral competition, right? So it basically operates on overs and unders, so a surplus and deficit and a carbon intensity target of the fuel mix, and it allows producers to compete for the most efficient abatement option. I think that's a way of encouraging competition in the market, which is what we need for lowest cost abatement. It's a way of encouraging innovation on the feedstock side, which is what we need for additional export products, not just fuel and not just feedstock, but the innovations that make feedstock cheaper and greener. But it's an early stage market, right? So we're going to need to do something on the supply side as well. ARENA's taken some important steps. It's great the Future Made in Australia Fund is there, but we've got to think really carefully about the sequencing of these things. I think if we go supply side first, we risk locking ourselves into a project that's too high up on the cost curve to compete, and it'll be undermined by imports over time, right? If we go demand side and we don't provide any supply side intervention, we risk importing first and kind of basically not developing the domestic market to our full potential.
Yeah, absolutely. And I might stick with you, James. You referenced earlier that there were some clear winners in relation to lowest cost decarbonisation pathways. So maybe firstly, can you elaborate on that a little? And then could you also give us an idea of where we can see that in the report?
Yeah, sure. So what I was referring to there was the supply curve. And so we've got that in the supply section, and it basically shows you a merit order curve of projects. They're synthetic projects. These aren't real projects in the market, but it's saying for each technology and feedstock, what would the effective abatement cost be? And so the lower your abatement cost, the more competitive you are going to be as a supplier into the market. In the report, the main body, we show what that abatement cost looks like for SAF. There's an equivalent chart in the appendix, which shows what that looks like for renewable diesel. So there is a reason that the majority of low carbon fuel, particularly renewable diesel and SAF projects that operate today, are heifer-based pathways using used cooking oil and tallow, right? And the reason is those are the cheapest, right? They're the lowest abatement cost. So that's where it starts. It's not to say that other technology pathways and other feedstocks can't become more competitive over time. It's just that some of them are going to need technology breakthroughs to get there. Some of them are going to need a much bigger demand signal before they can be incentivized and basically have the competition drivers that help them, either expand their feedstock supply or bring down some of the costs and increase the yields to start to compete with heifer. So if I was placing a bet today and demand was emerging, I think the first project that will get off the ground is going to be a heifer-based project.
Yeah, great. And maybe I'll throw a question to you, Rupert. From your experience and noting that, not all markets going to be the same, but from what you've seen, what have other markets maybe gotten wrong that we could learn from as we build out the LCLF market in Australia?
It's a good question. I think probably Fiona might even be better placed to answer that from experience in mandated markets, I suppose, and how that's playing out. But I suppose what I'm trying to do is to echo some of James's comments there on the policy roadmap, because mandates, so demand side policy, have been used. They're great. They certainly should be considered in Australia, and they are being considered, I believe, through the consultation period that was announced and at the Commonwealth Government level. But how does that work in with other mechanisms? So we in Europe at the moment, that Refuel EU mandate is operating now. It's operating in a way that a number of market participants aren't fully happy with how that's operating. More potentially teething issues, but how the costs for not achieving the mandates are reflected, and who's actually setting the price for the product as well. So these are all really complex policy considerations that need to be addressed as a policy sort of toolkit is rolled out. But you can't, as James said, you can't go too early on that demand side mandate. If you don't have the supply, you're going to create some real challenges and issues in the market from a price perspective. Ultimately, true believer, being an investor in capital markets and having the most competitive projects happen and rise to the top. And so policy, any government intervention through policy should always consider that and consider how you ultimately get the most competitive markets, because that will bring the lowest cost product to users, and have the enablers, whether it's demand or supply side policies, fostering that competitiveness in the market.
Is there anything you wanted to add to that, Fiona, on learnings you've seen?
Yeah, I think I mentioned it earlier, but I think what we are seeing, and James kind of alluded to it as well, you need to work out ways to incentivise across the supply chain to actually Act. And so in the EU, I do think one of their challenges is they use the demand side without actually putting the supply side incentives in, which has meant that supply has not come up to the levels that they actually need. And what we're seeing there is fuel suppliers aren't hugely incentivized right now to actually produce or scale this SAF supply because they can just pass the penalty price onto their end consumers, which are airlines. And that's ultimately not a good result for anyone because aviation becomes more expensive and there's not actually SAF flowing through the airports. So we want to make sure that doesn't happen here in Australia if the route is a demand side signal. And I think it is around that phasing of getting supply to that critical level and being quite practical in how you actually build this market. I did see a question referring to, don't let perfect be the enemy of the good. And I think that's certainly the case here of how do we bring on supply in a phased and pragmatic way, but ultimately to ensure that all parts of the supply chain are acting and are incentivised to act in the right way so that we minimise costs along the way.
Yeah, absolutely. So there's been a few questions in here on e-fuels and power to liquids. So I might throw to James. We know there's a big push in Europe. There's mandates in the EU and the UK. So is PTL really going to be a long-term solution? We know it's expensive. What can Australia do to support our emergence into the eSAF sector eventually?
Yeah, so I think eventually is the operative part of that sentence, Mila. There is a time and a place certainly for power to liquids if the demand reaches a particular threshold. So what we see in the modelling that we've done for this report is that there is a ceiling on the biogenic part of this market. So the part of this market that can be supplied by waste and agricultural products caps out as hydrogen costs come down, as we start to see more green hydrogen deployed. That will happen in the future. How long depends effectively on the scale of demand, so how quickly we ramp up, but also how quickly some of the costs for hydrogen come down. And that is a function of deployment. And at this stage, we need renewable energy superabundance before that becomes, I think, a credible possibility with abatement costs, say, below 1,000 Australian dollars a tonne, which is still quite a premium on where an ACCU sits today and where an ACCU might sit in the future. So it's perfectly possible. We would need to see probably an order of, let's call it 5 or 6 billion litres of just low carbon liquid fuel demand before that becomes really, really credible. And even in that context, I think if you've got a demand signal that's reaching that sort of scale, you're creating a massive incentive for those lower cost feedstocks to increase the availability of supply. So I think the answer on e-fuels is it's possible. We would need to see some really significant breakthroughs, and I can see ways that market forces might land on a different answer.
Yeah, absolutely. All right, I'll ask one last question, noting the time, and I'll go to Fiona. Does Qantas have any plans around how it would interface with domestic airports to increase SAF usage domestically?
Yeah, we actually recently, as part of the import, entered into a long-term partnership with Sydney Airport for exactly this reason. I think airports have a critical role to play, as we talked about, across the supply chain. Airports are a critical part of that supply chain, and they have their own Scope 3 targets. Sydney Airport do, as do a number of airports, where they're really looking at what can they be doing to incentivise the use of SAF into their airport. So the import was the first step in that. I know that they're also looking at what more they can be doing. I think where we've seen it done really well is London Heathrow. One of the reasons we were able to pick up SAF out of Heathrow the last couple of years was because they had incentives, including reduced landing charges, that enabled us to reduce that green premium again. And obviously the supply was in the market, and there was also government incentives through their RTFO credits that helped us do that, as well as our SAF coalition. So I think where the Australian airports can continue to look globally at what other airports are doing to encourage SAF use in their infrastructure, then that's ultimately where we want to get to. And we see the airport and airline partnership as critical.
Yeah, great. Thank you so much, Fiona. We'll have to wrap up on the Q&A there. Apologies if we didn't get to your question, but thank you for those jumping in and keeping the conversation going. And a big thanks to our panel today for such rich and insightful conversation, as always. Just to wrap up on some of the key messages that we've heard today, liquid fuels, it accounts for almost a third of Australia's emissions. And whilst electrification is making strides, we know that a significant portion of our fuel demand will simply be hard to electrify, which is where low carbon liquid fuels comes in. So the opportunity has the potential to be pretty massive. And we see in our report the potential for a $36 billion market by 2050, some really major carbon savings, and a chance to strengthen our fuel security. Right now, we're exporting billions in feedstocks, and without that local refining capacity, we miss out on the full value. So the message, it does become quite clear. Demand for liquid fuels will persist, as we heard from our panelists today, and Australia has a potential to take these leading strides in clean fuel innovation, as we see Qantas taking their first steps as well. So a shout out again to the Refined Ambitions report, which aims to lay out this practical roadmap with steps to help scale this industry, from improving market access and de-risking investment all the way to leveraging innovation and aligning the value chain. So with what we've heard today, we know that the right signals, the right collaboration and commitment will help keep momentum going in the space. So that's enough from me. A huge thank you to our panel, Fiona, James, Rupert, and a thank you to you for tuning in today. A reminder that you'll be emailed a link to the recording of the webinar. So if you had a colleague who couldn't make it, please feel free to share it on. A short survey will appear on your screen, so we'd love to hear your thoughts as well before you head off. That's it from us. Thanks for dialing in, and have a great rest of your day.